How much you can give tax-free to a family member will depend on how they're related to you. It's really important that you understand the implications of gifting to different family members, as the tax penalty can be quite severe and will be paid by the receiver of the gift. I'm Carl Roberts, Chartered Financial Planner at RTS Financial Planning. And in this video, I'm going to go through some of the gifting allowances that are available and some of the tax consequences if these gifts fail. So when we're talking about tax on gifting, we're generally talking about inheritance tax and whether inheritance tax is due on the gift that you have made. Now you can pretty much gift tax-free anything you like between spouses and civil partners. So husband and wife can transfer any number of assets or give away any number of cash to each other, and there won't really be any tax consequences of doing this immediately. When it comes to other family members though, you need to look at different allowances. So the first allowance to look at is the annular gifting allowance that everyone has. And this allows you to gift up to £3,000 every year tax-free. Now this can be spread across multiple people, but ultimately the total gifts you make as part of your annual gift allowance must total £3,000. It's not £3,000 per person. Now if you're in a marriage or a civil partnership, you've obviously both got your own £3,000 gifting allowance. And if you've not used last tax year's gifting allowance, you can carry forward 1 year of unused gift allowance. So if you didn't use last year's gift allowance, this year technically you could give £6,000 each if you're in a marriage or civil partnership. Now there's also something called the small gift allowance, and this is £250 that can be gifted to as many people as you like. Now you need to be careful, because if you've already used a gift as part of your gift allowance on a person, you can't then also give them £250. So you can use your gifting allowance on one person, for example, and then if you know 10 other people you want to give £250 to, you could do that. So small gift allowance, £250, no tax consequences. Now if you know a family member or someone else that is getting married soon, you're able to make a marriage gift without tax consequences, as long as it's within certain allowances. So if it's your child, you're able to gift up to £5,000 to the child getting married. If it's a grandchild or a great-grandchild, you can give up to £2,500 as a wedding gift. And you can also gift up to £1,000 to any other person, even if you're not related to them, as part of their marriage gift. So what happens if your gift to a family member is not tax-free? What if it's larger than the annual exemptions that we've already covered? Well, in law, there's technically no limit on what you can give away to a family member or any other person. It's just that if it's over the annual exemptions, it will usually be classed as what's called a potentially exempt transfer. And what that means is, if once you've gifted, you were to die within 7 years, then the gift could be reversed and brought back into your estate, and an inheritance tax calculation will be made. And if there is inheritance tax due on that gift, it will be the receiver of the gift that will have to pay that bill. Now, even if you were to die within 7 years of making a larger gift, there might not necessarily be inheritance tax due, especially if the gift, together with everything else you own at the point you die, is under what's called the nil rate band, which is an overall allowance for inheritance before you pay inheritance tax, and that's currently £325,000. There's also an additional allowance that you can use towards a family home if it's passed on in the right way. So it may be that your gift still falls within these allowances and there isn't actually an inheritance tax due. Now, of course, if you survive for 7 years after making the gift, then the gift will then be outside your estate and there shouldn't be any further inheritance tax implications. And again, like I say, this could be any amount of gifts. So you could potentially give away a £1 million house to your child, and as long as you survive for 7 years and you're no longer living in the house, then technically that could be gifted away inheritance tax free. But if you were to die within 7 years of making that gift, it would be reversed and there would be an inheritance tax calculation made on that gift. Now, there are things you can do to try and protect your gift or protect the receiver of your gift having to pay inheritance tax if you were to die within 7 years. The most simple way to do this is to use life insurance. So a whole of life policy or a 7-year term policy could protect the receiver of your gift if you were to die within the 7 years of making the gift. Now, as well as the 7-year rule, there's also another way you can make gifts. If you're making gifts on a regular basis and it's out of excess income, so income you don't need to cover your normal day-to-day spending, and it's regular and consistent, then again, potentially there's no 7-year rule on this. This could all be classed as inheritance tax-free gifts. But you do need to be careful because you really need to prove to HMRC that all of these things were in place. The fact that it was regular gifts, the fact that it was out of excess income, all of this needs to be documented clearly, and there's a big inheritance tax form to complete on death to make sure that this was all above board. But there's also something to explore. This works really well if you're paying insurance premium on someone else's behalf. Now, if you're planning to make a gift but you're concerned what will happen to the gift once it's in your family member's hands, perhaps it's to still a fairly young child, perhaps in their 20s, they've got most of their life to lead, and you're not entirely sure they're going to be that responsible with the money yet, you can use trusts to gift the money into trust, and it sort of adds a layer of protection around your gift and allows you to exert some control over the gift still. Now, there's 2 types of trusts that you can use in this situation. The first is what's called a bare trust, which is where you nominate the beneficiaries. You actually say, this is for child A, but I'm going to protect and monitor this money for them on their behalf, and I'll dish the money out to them at certain points when I feel they're responsible enough to have it. So if it's a bare trust, it's a bit like giving the money directly to the child. It will be classed as that potentially exempt transfer, and you'll need to survive that 7 years once you've gifted money into the trust. The second type of trust you can use is what's called a discretionary trust, and this is where you're not necessarily naming the beneficiary directly. You might just name a class of beneficiaries. You might say, this is for my children or for my grandchildren, children, grandchildren, great-grandchildren. And as long as you're not being specific, and the trustees of your trust, of which you could be your trustee, have discretion on who gets that money, this will be classed as a discretionary trust. Now, you need to be careful with a discretionary trust because money gifted into a discretionary trust could potentially be liable to inheritance tax straight away. The gift is classed as a chargeable lifetime transfer. Now, if you've got nil rate bands, if you've got some of that £325,000 nil rate band inheritance tax allowance available, and your gift to that trust falls within 325,000, then you wouldn't necessarily need to pay an inheritance tax charge straight away. But again, if you died within 7 years, there could be all sorts of ramifications, and everything would have to be worked back to see if there's further inheritance tax due. But trusts are just a really good way to ring fence the gifts that you're making, add some bloodline protection so that, should the receiver of your gift get into trouble down the line, perhaps through a divorce or bankruptcy or something like that, a trust is a way to ring fence and protect that money. Now, when we're talking about gifts, it's not just gifts of cash. It could be gifts of anything, gifts of houses, gifts of shares, gifts of very high expensive items. This all comes into the same rules around inheritance tax. It can be a really complicated area, so financial advice is definitely recommended.